In this video, we'll show you the indicators that predict the worsening of the recession in 2023 and reveal how you can prepare and even profit from the outcome. The recently released economic data show that things are already getting worse. The consensus was for a 0.1 decline in construction spending in October, but we saw a drop of 0.3, bringing the year-over-year increase to just 9.2 from the previous month's 10.9. However, because construction costs are spiraling out of control, it is important to keep this 3% decline in spending in perspective. Construction spending is down, which means construction is down because the cost of what is being built has increased significantly. Building costs and labor costs have increased significantly. Construction spending would be skyrocketing if construction continued at its previous pace, but it isn't, indicating that the actual construction volume is collapsing. Even though it costs more to build, less money is being spent because fewer buildings are being constructed. And the weak housing market, which will soon deprive so many Americans of their home equity, is a factor in the decline in construction spending. Do not make the error of assuming that declining home prices indicate lower inflation. Regardless of the price of a house, inflation will continue to rise. The cost of owning a home is what matters, and even though home prices are declining, monthly mortgage payments are increasing. However, if you already own a home, the cost of upkeep is more crucial than the price paid for it. Costs are increasing, such as the cost of utilities, insurance, maintenance, and taxes. Someone shared a copy of their fire insurance for the apartment building they resided in, which was a shared expense for all the homeowners in this community. The total cost of the fire insurance policy was about $300,000 2 years ago. Today, it is about $2 million. You're referring to a significant increase in insurance premiums, and there are two causes for that increase. One is significant losses from prior fires that the insurance companies had to pay for because this policy is being written in the fire-prone Lake Tahoe region of California. In addition, rising construction costs and other costs that must be factored into fire insurance premiums mean that if a house burns down, the cost of rebuilding is now significantly higher, regardless of the fact that the value of homes has decreased. Again, that has nothing to do with inflation. Those are the prices of the assets. Like stock prices, they will decline, but that doesn't mean that inflation will be relieved. Americans will continue to spend a large portion of their income on basic necessities and won't have enough money left over to purchase many of the goods sold by many of these companies, one of the reasons why stock prices will decline. Of course, the present value of those reduced earnings will decrease due to rising inflation and interest rates, which will also result in a decrease in stock price. The PMI then brought us more bad news regarding the manufacturing industry. Manufacturing came out at 47.7 in November, which was slightly higher than the 47.6 number from the previous month, but it's still a terrible amount. We are in a manufacturing recession, which was further confirmed by the ISM Manufacturing Index for November falling below 50. Keep in mind that any number below 50 indicates contraction. It debuted at 49 during the prime of the month when it was at 50.2, while 49.9 was the predicted value. Since May 2020, this is the first time that the index has fallen below 50. What happened in May 2020? The manufacturing sector is currently as weak as it was during the worst of the pandemic, because that was the extent of the lockdowns. These figures suggest that by 2023, things will be much worse. Here's how to get ready for the downturn. Disclaimer: I am not a financial advisor, and this is only for informational purposes. We are aware that the U.S. government would need to nearly double everyone's tax rate just to cover interest costs if interest rates rose above 5%. It is impossible to tax people so heavily at that point, which would make it impossible to pay off the debt. Everyone anticipates that the Federal Reserve won't raise interest rates all that much because it does not want Washington to run out of money. As a result, interest rates will never be higher than the rate of inflation, which will cause the dollar to keep depreciating. This suggests that the government will use inflation to reduce the debt to levels that are manageable, which further suggests that there will be a bull market in commodities and precious metals. Investing in mining royalty companies is one of the best ways to get ready for this inflation-induced recession, especially at a time when maintaining real estate is becoming more expensive. Instead of running the mines themselves, royalty companies take a cut of the profits from numerous ones, shielding them from operational risk. Some of the safest companies to invest in include Franco-Nevada, Metalla, Barrick, and Sandstorm. Additionally, Kinesis Money offers KAU and KAG, two fully backed cryptos with gold and silver. They collect transaction fees between 0.02 and 0.05%, which are then given to cryptocurrency owners. If you're looking for a safe haven, think about Kinesis, which currently has a yield of roughly 0.04% and will increase as the exchange grows and there are no storage fees. Learn how to make money from the housing crash by watching this video. I appreciate your time and wish you luck on your financial journey. Until next time, peace.